The Million Dollar Lesson, Jim Paul's story. Jim Paul was a rising star. He climbed the ranks in the commodities world. He became chairman of the Chicago Board of Trade. But then, it happened. Jim lost it all. $1 million. Gone. Poof. What went wrong? It wasn't just bad luck. Jim's story is a wake-up call. It shows how our minds can be our own worst enemies. Jim's story isn't about complex financial instruments. It's about human nature. We all make mistakes. But in the financial world, mistakes cost money. Big money. Jim's story is a lesson for all of us. It's about managing emotions, understanding cognitive biases, and respecting risk. It's about building mental resilience. Emotional roller coaster, the psychological pitfalls. Our emotions are powerful. They can lead us to make irrational decisions, especially when it comes to money. Fear, greed, hope. These emotions can cloud our judgment. We start chasing profits. We ignore red flags. Sound familiar? Jim Paul fell into this trap. He let his emotions dictate his trading decisions. He got caught up in the excitement of the market. When things went south, fear kicked in. He held on too long, hoping for a reversal. This is a common mistake. We get emotionally attached to our investments. We let our ego get in the way. Cognitive biases, the mind's sneaky traps. Our minds play tricks on us, it's true. We call these tricks cognitive biases. They're like mental shortcuts. They can lead to bad decisions. One example is confirmation bias. We seek out information that confirms our existing beliefs. We ignore anything that contradicts us. Another sneaky bias is the sunk cost fallacy. This is when we keep investing in something because we've already invested so much, even if it's a losing proposition. Jim Paul fell victim to these biases. He held on to losing trades, hoping to recover his losses. He doubled down on bad bets, ignoring the warning signs. Risk management, protecting your downside. Risk management is key. It's not the sexiest topic, but it's crucial. It's about protecting yourself from catastrophic losses. One rule of thumb, never invest more than you can afford to lose. This seems obvious, but people break this rule all the time. They get caught up in the moment. They think they're invincible. Diversification is another important aspect of risk management. Don't put all your eggs in one basket. Spread your investments around. This reduces your overall risk. Jim Paul learned this the hard way. He concentrated his bets. When those bets went sour, he had no safety net. Building mental resilience. Turning losses into lessons. Losing sucks. There's no way around it. But it's part of the game. The key is to learn from your losses. Don't let them define you. Use them as an opportunity to grow. Building mental resilience is crucial. This means developing the ability to bounce back from setbacks. It's about staying calm under pressure. It's about making rational decisions, even when your emotions are running high. Jim Paul's story is a testament to the importance of mental resilience. He didn't let his losses destroy him. He used them as fuel to educate others. Practical tips for financial success. Let's get practical. Here are some actionable tips for managing your finances and investments. Educate yourself. Knowledge is power. Learn the basics of investing. Understand different asset classes. Read books, take courses, follow reputable financial experts. Control your emotions. Don't let fear or greed dictate your decisions. Have a plan and stick to it. Manage risk. Don't invest more than you can afford to lose. Diversify your investments. Think long-term investing is a marathon, not a sprint. Be patient and focus on the long game. Remember, financial success is a journey. There will be ups and downs, but by developing mental resilience, managing your emotions, and making informed decisions, you can navigate the markets with confidence.